Video of this first part of the class is going to be that useful to us, but let's see what we might be able to put down that you can look at a little bit later. We're going to go through the quiz for Chapter 3, okay? Just like we did last time for Chapter 2 quiz. If you weren't here, you should be able to see that uploaded on Canvas now, okay, and it's linked you to YouTube. I think for some of those, even though I've embedded them in Canvas, you're better off if you just go out to YouTube to watch it, and then you can do the full cinema scope or whatever the heck they call that, so you get a little bigger image on the screen rather than trying to watch in that little box inside of Canvas. But anyway, we're going to do something similar today. However, today I'm going to ask you guys to do these, okay, because we are closing in on exam time. Our exam is not next time, but the time after that, right? And so we're starting to turn now to the point in the class where I'm going to ask you to work the questions for us so that you start to get into the mode of working questions so that we walk into the exam. Next time, after we do Chapter 3 quiz, we'll go through the Chapter 4 slides. I'll see if I can get you jump started on the Chapter 4 quiz. Next time when we meet, I will go through the Chapter 4 quiz with you, and we will have a practice midterm that will be comprehensive, that will have all different problems from different chapters. It'll be similar to the ones that you're going to see on your midterm, which we will then have on the 11th, right? The class after that. So everybody sort of sees where we're going. Okay, so we're to the point now where you're going to be doing the weightlifting rather than me kind of standing up here showing you how to do everything. Okay, I think it's better for you to practice that way. And don't worry, when I call you up, don't be shy. I'll help you. I won't just leave you there stranded without the ability to answer the question. So don't be shy about coming up and working it. So who wants to work this first one? Chapter 3. You want to try it? What was your name again, sir? Jeremy. Okay, thank you for volunteering. Do you want to try and do it on the screen, or you want to do it on the board? Huh? You don't want to try this? You can try it. It's not that bad. I'll put it in tablet mode for you. If your writing's probably going to be neater than mine, right? I don't think it can get much worse than the way I write on this thing. And I'm going to close that door so you don't have to deal with all that glare. If somebody comes in, can knock. And I'm going to give you the pen here in a second. Now, the only thing is, I'm afraid I got out of range of the microphone. We might have lost the audio. Let me see real quick. Sorry. Just make sure we're still tracking here with sound. Test 1, 2. Yeah, we're still good. Test 1, 2. Okay. All right. So I'm going to go ahead and drop that. And I'm going to show you how to do the pens. So you hit pens right here. And you get the pen. You want black, red, blue? Blue. Okay. So you got the blue. And you just press and write. 1 plus 1 equals 2. Okay, don't break it. Just do it lightly. And if you make a mistake, you hit the eraser and you erase, and then you go back to your blue pen. All right, so you want to go ahead and try this one and talk through us what you're doing. Okay, let's just go ahead and look at this question. The balance in the supplies account on June 1st was $5,200. So why don't you go ahead and show me what that would look like in the T account if it was $5,200 with the beginning balance. How you doing? Okay, so we have that $5,200 balance. Okay, good. Why don't you write that, erase that real quick? Erase that 5,200. You're right the way you did that. But go ahead and put it, you know how we've been doing the balance? So there's another little line over here, and give me the balance. Over here on the wall, all the way to the right. I mean, all the way, yeah, to this right. Yeah, just put balance. Okay. Okay, good. So we got a balance, and just write that under there, 5,200. Okay, good. So we got a balance of 5,200, and then we bought some supplies. So why don't you give me the journal entry over here to purchase the supplies? Go ahead and write that journal entry. Journal entry. General journal entry. Good. See how much neater he is than me? Look at that. They purchased supplies for 3,500. For 5,200. It's okay. Don't be nervous. That's why God created erasers, even if they are electronic. Okay, good. And credit cash for 5,200. Nice. The only thing I don't like of what you did there was I would indent the word cash. That's okay. You don't have to change it, but always indent that word to the left as well when you're trying to make a credit, right? Okay, good. Now you want to post that to your T account? Wait a minute. He was right. Who said 5,200? They purchased supplies for 3,500, didn't they? Don't interrupt the man when he's working. Fix that. They purchased supplies for how much? 3,500. So debit supplies 3,500. Look at now this is a mean accountant. He says I'm not going to leave that over there. I'm going to fix that. Okay. 3,500. Credit cash for what? 3,500. Nice. Now you're going to post that up. Okay. What's the balance in there now? 8,700. Okay, so go ahead and put that balance 8,700. You guys are allowed to talk to him. It's not like he's, on the. I know he looks like a movie star, but it's not like he's on film up here. So you can speak to him and help him out by adding the numbers up for him. Okay, you should have your calculators busted out and helping him. So we got a balance 8,700, right? After that purchase. Now the problem says that they counted the supplies and they had 3,000 on hand. What does that mean? 3,000 on hand, look guys, means they have it. Is this money on my hand? Sometimes we say in my hand, but it's on my hand too, isn't it? So I've got this money on hand, okay? So they have some inventory on hand. They got 3,000 on hand, right? So what happens? That means they must have used some, right? The 8,700 was there. They only have 3,000 left. If you have 8,700 apples and then you count, you only have 3,000 left. How many did you eat? 5,700. Good. Give me the journal entry for that when you use those puppies up. Well, why are you erasing that? Squeeze it in there somewhere. That's all right. It's okay now. Hit undo. See if it puts it back when you hit that undo. That right there, that little back arrow. No, right there, yeah. No. Right there. See if it puts it back. Yeah, it does. Hit it again. Hit it again. Hit it again. Hit it again. It's coming back one word at a time. Isn't this exciting? There you go. Okay, good. So you go ahead and put that back and then just write in what you would do as you use the items up, right? Good. Those items have expired, haven't they? Debit supplies expense, because those things aren't here anymore. They expired. They're gone, right? So since they expired, we debit supplies expense for 5,700. Credit what? Supplies expense. You're on eraser. That's all right. Hit cancel. Go back to your pen. Dip your pen again. Don't mess up my computer. No, it's okay. Don't worry. Go ahead and hit that X, that red X. The red X. Close that. Close that file. Let me see. Let's see if we get this thing. That's all right. Don't worry. Huh?
I thought the board might have been a little easier.
Yeah. The problem is that then people can't come back and watch to see how we did it. Task Manager. Where's Microsoft Word? No kidding, it's not responding. End task. Okay. Looks like this thing is still working, so we're good there. So now we just got to open up the file again, which that file is sitting on Sammy. And we're looking for BA 101A. We're looking for quizzes. We're looking for chapter 3. Okay. And I'm going to put that guy up there like that. Let's see if it'll let me have this back. No. Okay. So, what happened? You got the pen still? Oh, okay. Okay, so what do? We sat here and we purchased the supplies, right? Okay, when we purchased the supplies, we went ahead and we did what? We debited supplies for how much? 50, 33,000? 3,500? 3,500. See, I'm not much better. We debited the supplies for what? Maybe that'll work better. Maybe you guys just tell me. I'll call a person up and they can tell me what to do. So we debit the supplies 3,500 and we credit cash or whatever for 3,500. Okay. And the supplies account had a balance in there of what? Of 5,200. Okay. And when we purchased those additional 3,500 now, just posting that, right, we ended up with 8,700. Okay. And then at the end of the year, whatever, we came along and we counted our supplies and we had what? We had 3,000 left. So if we're wanting to end up with a balance of 3,000, that means we must have used what? 5,700? Okay. Right? So we would go ahead and we would debit supplies, what? Expense for that portion that has expired for 5,700 and credit what? Credit the supplies account for 5,700. Those things are gone now, right? We want to reduce that asset, so we credit it. Right? Okay, excellent. Good job. All right. Okay. This next one, who wants to do this next one with the depreciation? Huh? No, I want to see how you got the number. You want to do this one?
Yeah, I'll do it
Okay.
because there's no room.
Oh, you can squeeze it in there. Go ahead. Well, you say there's no room? You feel there's no room?
You probably can't read it.
There you go. All the whiteboard you want. There you go. Okay. So for this one, you got to hit, I think, pen probably up here at the top. Pen. You hit pen up there just to get the pen going. Just hit pen. Okay, good. That's all you have to do. Okay. All right, you're good to write. So we've got, of course, now we can't see the problem. Put the problem back. Hit the Word file down there at the bottom. The Word file. Yeah, go ahead and hit that Word file. Okay. So for this question number 2, they're telling us that they purchased equipment of 7,200. It is estimated the annual depreciation on the equipment will be 1,800. If the financial statements are due to prepared on December 31st, that's what? 1 month after purchase, right? Okay. Then what would be the journal entry? But show me how you got that journal entry by hitting that little triangle down there at the bottom, that multicolored triangle. Okay, now you can go ahead and you can write the how you would have figured that. Just go ahead and show me what you wanted to write. So you're purchasing equipment. Okay. Okay. Why don't you tell me what to write? Go ahead.
And the
You can stand over there. Okay.
debit equipment.
I'm not sure how you got me here. Good thing I was keeping it honest in terms of what sites I was looking at here. Okay. So what are we doing? We got equipment. Okay. What did you want to do with the equipment?
Debit for the 1700.
You purchased the equipment for 1,700.
7200.
How much?
72.
7,200. Okay, 7,200. Okay, good. And what? Credit cash?
Yep.
Okay. So we bought the equipment for 7,200 for cash. Okay, good.
The annual depreciation 1800. So it's annual, so it's 12 months.
So the annual depreciation is 1,800,
Uh-huh.
but they bought that equipment on what? December 1st. So you want
1 month.
1 month of depreciation. So what do you want to do with that?
Divided by 12.
Divided by 12. This is not cell phone time, guys. If you're going to be using your cell phone, you might as well just go ahead and be with that person. 1,200 divided by what? 1,800 divided by 12 is what?
150.
150 per month.
Mhm.
Okay, good. And then what?
Debit depreciation expense.
Okay, you want me to debit depreciation expense for that 150 for the 1 month, for the month of December? And what do you want me to credit?
Accumulated depreciation.
Accumulated depreciation of 150?
Yeah.
Okay, good. And that was the answer to that question?
Yeah.
Okay, let me ask you another question, since you're so good at this. If I sit here and I prepare my balance sheet, how do you want me to show this equipment and this depreciation?
Gonna set up a depreciation accumulated depreciation account with a credit of 50.
How do you want me to show the equipment?
Hmm?
How do you want me to show the equipment?
Credit 150.
You want me to show the equipment as a credit for 150? How do you want me to show the equipment?
Just take it off.
How do you want me to show the equipment?
Just take it off. Take 150.
How do you want me to show the equipment?
Credit.
How do you want me to show the equipment? I'm waiting for you to answer my question. You're answering everything but my question. How do you want me to show the equipment?
Debit. All right. Credit 150.
You want me to show equipment, credit 150? Like that on the balance sheet? That's what you just said to me. Okay, how do you want me to show the equipment?
I don't know.
You don't know how you want me to show the equipment? Is it an asset?
Yes.
Did I debit it for 7,200?
Yeah.
Per your instructions?
Yeah.
So is it going to show on the balance sheet?
Yeah.
It's for how much?
5,400.
No. How come you're trying to tell me to show an account on the balance sheet for an amount different than the only journal entry that has hit it, which is 5,200 equipment? Don't use your imagination. If I've only debited equipment for 7,200, how can I show it for anything else but 7,200, right? So how much you want me to show the equipment for?
150.
Okay, if I'm going to prepare my financial statement, I have equipment here. You just told me to debit it for 7,200, right?
Yeah.
Okay, so how do you want me to show equipment? Do you know how to prepare a financial statement from a set of T accounts?
Yeah.
Okay, so if the T account says that the equipment has 7,200, then how much do you want me to put down for equipment on the balance sheet?
1,700.
7,200, good. Okay, and then you told me to credit the accumulated depreciation for 150, didn't you?
Yeah.
Okay, so how do you want me to show the accumulated depreciation?
Make it.
How do you want me to show the accumulated depreciation? Can there be anything else other than $150 in the accumulated depreciation since I've only credited it once for 150?
No.
That's a credit? Okay. Then what do you want me to put down here?
The difference.
I'm going to call this the book value, or I could call it carrying value, net book value, whatever. Book value of what? 7,050,
Mhm.
right?
Yeah,
Right?
I think so.
Okay, don't use your imagination. If I say what's in the equipment account, you got to put what's in the equipment account. You can't sit there and start answering a different question. If I ask you what's in the accumulated depreciation account, you just got to put what's in there, right? Just like in those connect exercises, it didn't start rolling numbers up for us and putting in there. It put in exactly what we commanded the machine to do in terms of debit and credit, right? Okay. All right, one more. So give me the depreciation entry for January of the next year.
150.
Debit depreciation expense, credit accumulated depreciation 150, right?
Yeah.
Okay, now what do you want me to do? I post this 150 over here. Now help me prepare the balance sheet at January 31st of that next year. How much is in the equipment account? How much is in the equipment account?
177.
7,200. Good. How much is in the accumulated depreciation account now?
300.
Good. 300. Excellent. So now it's got 2 months worth of accumulated depreciation. So now the carrying amount of this is what? Help from the colleagues, please. Huh? 6,900 is what's in here now? And so on, right? I won't make you do 12 months worth. Okay? Okay, good. Nice job. So, look, when I ask what's in an account, you look at what's in the T account, and that's the answer, right? Don't overthink. And the reason I'm pushing you that way is what? You get a question on the exam, and it asks you something that simple, and then you start thinking too much, and all of a sudden, and they'll always have a choice down there to mess you up, right? So keep it right there in front of you in terms of what we're doing, right? Okay? All right, good. Good job. Okay. So now we are looking at number what? 4? 3? Okay. All right, good. Who wants to do number 3 then? Oh, I got 2 volunteers. We'll let this gentleman do 3 and you'll do 4. How about that? Sound like a plan? Okay. So come on up. And we've got this REM, and they received a check for $27,000 on July 1st, which represents 6 months advance payment of rent on a building. Building it rents to a client. So they rent some building to the client. Unearned revenue was credited for the full $27,000, and now we're going to prepare the financial statements 1 month later, right? Okay. You want to? What was your name again, sir? Matt. Matt. What was your name? Marlena? Sorry, Marlena. Forgot to ask your name last time. Okay, Matt, so you want to give me the journal entry first for the receipt of the cash? Yeah, you can try it right there if you feel comfortable that you can write it in. Yeah, that's fine. Look at that. Man's a pro. See, I didn't know you could write on the edge of that thing. Okay. And we're going to credit the unearned for what? 27,000? Okay. It's not going to let you write on the edge, yeah. That's okay. We know what you mean. So just come back down to that question. Okay, so it's 27,000, right? You credited unearned what? Unearned revenue for 27,000? Okay, good. So now 1 month has gone by, right? So how do you want to handle that? Show me the calculation. You can put the calculation up there, kind of above where you wrote this. You can put it right here, the calculation, to get how you're going to figure out 1 month's worth. 27,000. Okay, that's a different way of showing it, but if you say so. Usually I would put 27,000, I'd put it over 12, but that's okay. You can, but you should have some colleagues here that are willing to help you. Oh, it's not 12 months, it's what? 6-month contract, right? So go ahead and fix that hit eraser. Erase that 12. Put that 6 in there. and someone's willing to help you with that. Is that a 6? Okay, so that's 4,500. Okay, okay, good. So we have $4,500 per month that we what? Huh? Well, we got paid 27,000 in advance, didn't we? But we have to earn that over time. So we earn it what? A month at a time. We've earned 6. We've earned one of the 6 months, or 4,500, right? Okay. And so you're going to debit the unearned and take the revenue, right? Okay. Show me what's in the unearned revenue account now. I could give you the same question on the test, and at the end I'll ask you, tell me the balance in the unearned revenue account after that. Go ahead and set it up. If you want to do a T account, please don't call it a T chart. For us accountants, that's like blasphemy. It's a T account, okay? Good. So it originally had how much in there? 27,000. Was it a credit? Okay, good. Man's on fire. Okay, and what did we just do to it? Debited 45. Go ahead, put that in. Nice. Okay, what's the balance in there now? Go ahead, you can write right on top of those words. 22,500, right? Because it's a liability, we debited it, so we reduced it. Nice. Good job. Made my day. Good work. Okay. So let's look at this next one. As a prepaid expense expires with the passage of time, what do? Did we have one up here where we had a prepaid expense in our supplies? Right? Okay, and once that starts to expire, what do? We go ahead and we can see that through that writing there. We debit the expense account, credit the asset account, because part of that asset has expired, hasn't it? We've done that 52 times now. Okay. Okay, good. Let's see. Sir that wanted to come up and do one, why don't you come up? Huh? Come on up. We'll help you. We won't leave you hanging. We're all a team here, right? Did the Raiders win Sunday? Did the Raiders win Sunday? You don't like the Raiders?
I don't like football.
Well, you know what happens if the Raiders lose on Sunday when I'm making your test.
They're going to win.
Yeah, you want them to win, right? So I don't get upset. Huh? Isn't it obvious? Okay. Okay. That's right. I'll help you with it. Okay. So we got number 5 here. Okay. And you can write the answer number 5. You can just sort of write in this white space that you have here near the bottom. Okay. So what's happening? We've got this one where there was a proper adjusting entry at June 30th. And the end of the fiscal year based on prepaid insurance account before adjustments was 18,500. Okay, so go ahead and make me up a T account of insurance, prepaid insurance. Nice. Prepaid. You can just put INS for insurance. Okay, good. Nice. Beautiful. Look at that beautiful T account. I've never seen a T account look that good before. I never make them that good. Okay, now what happens? We have a balance in there, so give me another line off over here for a balance. There you go, and put BAL on top of that. Yeah, there you go. Okay, so the balance. Nice. Okay, so the balance was what? 18,500? Natural born account. Look how neat he is. 18,500. Okay, nice. So we have a balance of 18,500, right? Okay. And they tell you that there's unexpired amounts of 6,000. In other words, what? I had 18,500 apples. There's still 6,000 sitting there that aren't expired yet, right? Just like my insurance isn't expired yet. Okay. So if I want to turn that 18,500 into a 6, what do I have to do with this account? No, you either have a choice. You either debit it or you credit it. When you're trying to change that number in that balance, you're going to have to debit it or credit it. Okay, if I had my magnets here, you'd be up on the magnet board paying penalties right now. Okay, when assets increase, you.
Debit.
When they decrease, you.
Credit.
Is prepaid insurance an asset?
No.
It's not.
Is it not?
Prepaid.
Oh, prepaid.
Prepaid has future economic benefit, doesn't it? You pay in advance, right? I get this insurance for however long the policy is on this thing. Okay, so if this is an asset and I want to reduce it, do I debit it or credit it? Okay, go ahead. Bring it to 6,000. No, I want it to end up with a balance of 6,000 in there. You need the calculator?
Yeah.
Okay. Tell me what you want calculated.
So it's gonna be
18. Right here. 18,500. Okay. And if I want the balance in there to be 6,000 is the answer to the question. So go ahead and put a line here. Put a line down here. Right there, yeah. Go ahead, put a line there. Write 6,000. Okay, so if you have 18,500 and you want it to be 6,000, what would you do? Forget about accounting.
so minus.
You would subtract how much? 12,500. Good. Go ahead, write that in. Minus 12,500. Is it 6,000 now? So now back to accounting. To reduce an asset, to make an asset smaller, we credit it, right? So what do you want to do with this to make it 6,000?
So we'll need 6,000 and credit.
No, I want to make
Oh,
it
so
6.
12.
Good. 12,500. And that gives me a balance of how much? 6,000. Okay, good. So that means 6,000 has expired, hasn't it? So give me the journal entry now for that whole journal entry. You already told me half of it. You credit the prepaid insurance. What do you want to debit? 6,500. No. No. If I credited the prepaid insurance for 12,500, I gotta debit something for the same amount. No. Okay, the debits equal the credits, right? Okay, so if I credited something for 12,500, I have to debit something for 12,500, right? What do you want me to debit? 12,500. What do you want me to? So show me the whole journal entry. Credit that. You just credited it. Huh? Why are you giving me another T account? I'm not going to give you any more points for more T accounts, man. I already said how beautiful it is. Don't try and run that one by me again.
So would it be in the same T account?
No.
So you have to do another one.
Okay. All right. Right here. Look. Come over here. Okay. So we go through the process. When we have an asset that has 18,500 in it, right? You told me the prepaid insurance was an asset. You told me it was an asset. It had a balance of 18,500, right? Right? Okay. And then what? Then we said we wanted to make it 6,000, didn't we? So in order to make it 6,000, we had to credit 12,500, which is exactly what you did up there on the screen, right? Okay, now I'm asking you, what's the whole journal entry? Now I'm asking you to make the journal entry in general journal form. You debit prepaid insurance, you credit prepaid insurance 12,500, right?
Yes.
That's that entry. I'm asking you, what do you debit? If I'm telling you you credited something, you got to debit something else, don't you?
So you'll debit the rest or what's left on the.
Look, credit, debit, they have to balance, right?
Yes.
I've already credited this. That's that credit right there. So it's now 6,000 in there, isn't it?
So you credit. No. So
I already got the credit. I'm asking you for the debit now. What account do you want me to debit? Not cash. Cash is an asset. We have what?
Expenses.
We have an insurance expense. Somebody helped you. Insurance expense of 12,500 because that asset has expired, hasn't it?
Yes.
Right?
Yes.
So since that portion of that asset expired, we debit insurance expense. We credit the prepaid. Now we see that we have 6,000 left in this account, right?
Correct.
Okay. All right. So good. You need to practice with that. With that very first example that we did. Okay. Now last week wouldn't have really helped you. We sat there and we went through that one example. Remember, we had the insurance. We got a 2-year insurance policy, 1,200, and it was 600 a year. And that's exactly what we did. We debited the insurance expense, 600. We credit the prepaid. I'm telling you guys, every single one of these questions in this practice exam go back to that very first example. Okay, so if you're still having trouble with that part, you need to, thank you, sir. You need to go back. Good job. You need to go back and you need to watch the video on that thing. I think I did that thing like 3 times or something. I did it in class a couple times, put the video up. I sat there by myself talking to myself in my house one day going through that thing. So go back through it and watch that thing. That ends up answering almost every single question in here, right? Okay? Huh? That year 1, year 2 example, yeah. We called it the in-class example. I think I put it up there under chapter 2. But in chapter 2, I was already tipping you towards chapter 3. These kinds of things. Okay? Okay, guys? All right. Who wants to do the next one? And don't feel bad if you come up and you have trouble with one, guys. This does not count for, this is all good if you sit here and you do this. If you have trouble with it, it's not an embarrassment. The embarrassment would be not getting a good grade in this class, right? That's what we're trying to avoid here. This is all practice. If you drop a ball in practice, nobody cares, right? Just don't want you to drop it during the Super Bowl. Okay? All right, good. So let's go ahead and you want to try this one, sir? I don't know. Which one was it? 6? Okay. Which one do you want? 6, okay. Okay, go for it. Okay, and if you want to, you can write in this little white space at the bottom of the top of the next page. So NWA signed a 4-year note payable in the amount of $20,000 on September 1st, and yeah, they want it at the end of September, so that's 1 month, right? Okay. I'm jealous. Everybody has nicer writing than me. 20,000. That's the principal, right? Times. Okay. Time after time. Never mind. If I could sing, I wouldn't be here, right? I wouldn't have been an accountant. Times 9% interest. Okay. Times 1 month out of a whole year. Right, that 9% is an annual rate, isn't it? Good. So we turn it into a 1 month rate by multiplying it times 1/12, right? To a 1 month calculation. Beautiful. Okay. Now let me ask you this: how are you going to plug that into your calculator? You don't have to do it right now, but just tell me the process.
Yeah, you would do 20,000
Mm-hmm.
times 0.09.
Okay. Hit equals. right? Get the number, because if you don't do that, it's going to take 0.09 times 1.2 before it'll and we don't want that, right? So I guess for that it wouldn't matter so much. Anyway, do it the way I said, 20,000 times 0.09, hit equals, right? Now here, you wouldn't have to multiply by 1. That'd be kind of silly, right? But if there was more than 1 month, you'd multiply it by whatever the number of months are in the numerator, right? Hit equals, and then here you can just divide by 12, right?
12 would
Right.
be 150.
Okay. Beautiful. Since you did so good, since you did so great, what would happen if I asked you to make the same calculation at December 31st?
It would start off the same 20,000
Mm-hmm.
times 0.09
Mm-hmm.
equals times 3/12.
Count on your fingers. You count on your fingers for these.
Oh.
All of September, all of October, all of November, all of December, 4 months, right? Now you won't do that on the test. Always count on your fingers for these, because I'd make that mistake all the time. I used to make that mistake every single time. Finally, I'd sit there and count on my fingers until I figure it out, right? Okay, so that's what you meant. Yeah, right. Okay, that's times 4/12. So go ahead and put that times 4/12. Just make that a 4. Make that one a 4. Good. And that gives me now what? 600? Okay, good. So you can go ahead and change that answer to 600, right? All right. Nice job. Beautiful. Good job. All right. Thank you. What's your name again?
Alistair.
Alistair. Good job, Alistair. Okay. We're good? Okay. Okay, good. All right. Who wants to do the next one? You want to do the next one? Okay. All right, Uncle Tupelo. I think these are all the name of rock bands or something. I didn't come up with these names. Okay, so we got this Uncle Tupelo, and signs a 3-month note payable to help finance increases in inventory for the Christmas shopping season. The note is signed on November 1st in the amount of $75,000. Annual interest is 12%. And what is the adjusting entry at December 31st? And you can see the journal entry there. So why don't you show me how to set that up? How to get that $1,500? Good. Got the principal, 75,000 times 12%. If somebody wanted to loan you money at 12%, what would you tell them? Jump in the lake, right? Times, Tell them to jump in the lake. I'm sure your parents will loan you money for less than that. Your mom will only charge you 10%. Come on.
Someone to borrow money at 12%. I was like, oh, all day long.
Okay, and you multiply that by what? By the 2/12, all of November, all of December, right? Okay, good. Did that give you the 1,500? Okay. Here's how you do this, guys. Everybody, break out your calculator. I'm telling you, you're going to keep getting weird numbers if you don't do it the way I'm telling you. Everybody do it. 75,000, put that in your calculator, times 0.12, hit equals, times 2, hit equals. Did you hit equals? Times 2, hit equals, divided by 12. Did you get 1,500? That's how you do them. If you don't, the calculator starts playing games with you. You got to hit equals each time. Okay. Go ahead. Don't do it the way I'm telling you, and then you'll be sitting there on the exam, and you'll come up to me and you'll say, are you sure? Did you make a mistake when you made this test? Okay. What's your name? Julie. Good job, Julie. Hang on, Julie. I got another question for you. Did you have a question, Sherry?
No, you just answered it.
Okay. So they're going to pay this interest in 3 months, aren't they? So when are they going to pay this? When are they going to? When is this note due? November, December. You just gave me the interest payable at December. They're going to pay it what? January 31st? Okay, maybe February 1st, whatever. So go ahead and show me the journal entry at December 31st. See if you can do that one. I mean, not December 31st. That is January 31st.
You want me to do the calculation, or you want me to input?
Do the calculation, yeah. 75,000, good, times 0.12 times, I only have 1 month now, right? Just January.
Okay.
Because we already accrued it at the end of December, didn't we? So now we're just doing what? Now we're just doing the January 31st entry, right? Okay. So what's that, colleagues? 750. Okay, so that equals 750. Okay, good. Now go ahead and give me the journal entry now to pay that thing off, and we'll pay it on January 31st, I guess. You can write it up somewhere where you got some white space up there. Debit, interest. That's all right. Just put int. That's fine. Inter is fine. Yeah, you got to dip it in the pen. Think of it like dipping in ink. Hit those little ink colors up there like you're dipping it. There you go. Debit interest expense. Beautiful. 750. That's for the Okay. Okay, now okay, go ahead. Go ahead. That's fine. Okay, but I want you to pay the interest now. Pay the interest now. It's January 31st. The guy wants his money, doesn't he? Okay, so go ahead and make the journal entry to pay that, to pay the man. Okay, are you going to pay him cash?
Yes.
Okay, so I guess you better credit cash, right?
Do I erase all of this?
No, you don't ever have to erase it. Just write it up there right above number 7, right where it says Uncle Tupelo. Go ahead and credit the cash. You got to pay cash. You got to credit it, right? You got to pay the cash, credit the cash. Go ahead, go to where you want it. Okay. Go ahead and hit in that ink. Hit in the ink. No, in the ink. Okay, you're all right. Is that a credit to cash?
Yeah, I was trying to erase it.
Okay.
So it's
Okay. The guy's just going to take 750 from you?
Is it 1,500?
How much do you owe him?
Or is this for November, December?
November, December, and January now, right? You just told me the interest for January was another 150, wasn't it?
Yeah.
So you got to pay him all 3 months, right?
2,250.
Is that right? 2,250? So credit the cash, 2,250. Just like an eraser. Just like an eraser. Dip them back. Okay. 2,250 because you're paying him. Okay, what are you going to debit? Did you just pay a bill? It's a liability. Interest payable.
Interest payable.
So you want to debit that to pay it? That's a debit, right? And the credit is to cash? Okay, because we had to pay the what? We had to pay the November interest to December interest, and I'm assuming that thing was due on December 31st. We had to pay him December 31st, didn't we? Right? Do we have to pay him anything else?
So when
That was January.
when that closed out though for December 31st, and you would started new for January 1st.
We
right?
did start new. We hit the interest expense for $1,550 for year one. That's the journal entry that was the for $1,500. That was the answer to that question, right? And we credited interest payable for $1,500, right? What was the amount of interest payable at January 1st? The interest payable at January 1st. Okay, hang on. Thank you. I'm going to go ahead and walk this whole thing through now because apparently we're not quite following everything. Okay, so what happens? How much did we borrow from this guy? We borrowed $75,000 from this guy, right? And we borrowed it on what? On what day? November 1st, okay? So, and they asked us to make the journal entry December 31st? Okay, that's 2 months. All of November, all of December, right? So we take that $75,000. What was the interest rate? 12%. Times 0.12 times what? Times 2/12. And was it Jennifer? Julie told us that was $1,500, right? Okay. So at 12/31 of year one, whatever it was in this example, I debit interest expense for $1,500, which was the answer to that question. I credit interest payable for $1,500, right? Okay, so I go ahead, I prepare my income statement, my revenue, minus my expense, assuming my revenue was 0, let's say, and that was my only expense, so my expense is how much? $1,500, so I have a net loss here of what? Of $1,500, don't I? Okay, so then I go ahead and I make my closing entries. I debit my income. I don't debit my income summary. I do what? I debit my income summary. What am I saying? Debit income summary for $1,500. I credit the expense account for $1,500, don't I? To close the expense account because it has to be 0. Okay, and then I debit my retained earnings for $1,500, and I credit my income summary, right? So that's 0. $1,500, right? Now my interest expense is back to 0, isn't it? Okay, now I go into year 2. How much is in my interest payable account right now? How much is interest payable right now? Interest payable is still showing a balance of $1,500. I didn't close that. I don't close my balance sheet accounts, right? Interest payable is still showing $1,500, right? Okay. Okay, good. Now I go into year 2 and I accrue that interest now for just that 1 month, don't I? So I take the $75,000 times 0.12 times what? 1/12, just the 1 month. How much was that? $750 we said? That's $750. So I debit interest expense for $750. I'm sorry, you say your name was Julie? Julie, you wanted to go ahead and set up interest payable for that. I didn't think that was necessary because all I'd have to do here is debit what? Interest payable What's the interest payable that I'm paying now? I'm paying the guy $1,500 now, right? Am I paying this guy $1,500? Don't use your imagination. Is there $1,500 there? Do I have to pay him? Okay, so I'm going to go ahead and I'm going to debit interest payable $1,500. How do I pay people? With cash. So I go ahead and I credit cash for what? 2250. Did I pay the guy? Right? So that interest expense for year 2 was just the 1 month, wasn't it? Interest expense for year 2 was just that 1 month. That was the only part that was an expense in year 2. The year 1 expense was for the 2 months that were in year 2, November and December, right?
The payables what came around, I forgot that
The payables on the balance sheet, it goes forward, right? Right? The expenses zero out. We always want those to start back at 0, right? Okay, now, back to my question. Is there anything else we have to do? If there's... That's right. If there's nothing else we have to do, I want to borrow money from this guy, right? Because he gives you $75,000, you just pay him the interest. He lets you keep the principal. We got to pay the principal too, don't we? So what we do, we would debit note payable for $75,000 to pay the guy his principal back in credit cash, right? For $75,000. So now this guy likes us, right? We paid him the interest, we paid him the principal back, right? Right? Can I clear this? Okay. Okay, good. Let's try this one. Who wants to do number what? We're on 8 now? Let's see. I got 3 volunteers. I'll let you do 8, 9, 10. Just going from left to right, right? How's things in Hayward?
Fine.
Where you must be up in the nice part of Hayward.
Right by Castro Valley.
Oh, okay. There you go. Good answer. Okay. Yeah, you can just do it right there. Go ahead and let's look at the problem. What is the proper adjusting entry at June 30th, the end of fiscal year, based on prepaid insurance account before adjustments of $15,500 and unexpired amounts of $6,000? We already worked this question? Sounds very similar, right? Okay, so go ahead and, what's your name again? Diana, go ahead and set me up a T account for the prepaid insurance. You know what I like about this particular part of this exam? It's got the green and gold of the Oakland A's. Isn't that beautiful? Okay, so we've got a balance of what? 15,500. Good. That was the beginning balance. And you want to turn that into an ending balance of what?
No, of 9,500.
No. I want to turn it into an ending balance. They tell me unexpired amounts of 6,000, right? Okay, so go ahead. Put down that ending balance down there, 6,000. We know where we're going on this. Good. So you want that to be 6,000. What are you going to do to it? Huh?
We're gonna credit
Credit the prepaid insurance, right, for 9,500? Right? Okay, good. What'd you debit? Huh? Well,
Wait.
that would be doing nothing if you debited and credited, right? Okay, so what do you want to debit? Has some of that expired? Some of that has expired and it's an expense, isn't it? So what do you want to debit? It's expired, hasn't it?
Yeah.
Well, if it's expired, what do you want me to debit? Is prepaid insurance an asset?
Yes.
Huh?
Yes.
And you just credit it to reduce it, right?
Yes.
So we have to debit something, don't we? If we credit something, do we have to debit something else?
Yeah.
Okay, what do you want to debit? Huh? Well, has the insurance expired?
Yes.
Okay, so wouldn't you debit insurance expense since it's expired? Okay, come over here. You don't know where I'm getting the 9,500?
No, I said 9,500, but you said no.
No, I didn't say no.
Yes, you did. You said no. You said that there's no space.
Well, because you wanted to debit the same account. If you debit and credit the same account, that's nothing. That's right. You can't debit and credit the same exact account. If you do, the only reason you would do that is because you made a mistake, right? But just take a look. I have what? I have the insurance that I bought, so I probably debit the prepaid for how much did they have in there as a balance? 15,500. I credit the cash. 15,500. That's when I purchased the insurance premium, right?
Correct.
Okay. And so I'm just going to go ahead and I'm going to debit the prepaid just like you did in the T account for 15,500. So now I have a balance of 15,500, don't I?
Oh, yeah.
Which is where this whole thing started.
Yeah.
Okay. And you have an asset now, right? Okay. Then what happens? Then you come along and you look at that asset and you say, you know what? There's only, what was it? $6,000 worth of value there left, right? It's like I had 15,500 apples. Now there's only 6,000. So I must have done what? I must have ate 9,500, which you correctly credited to the prepaid. So now the asset is showing 9,500, right? So if I credit the prepaid for 9,500, I'm just writing that same thing in general journal form. That's that credit right there. I have to debit something, don't I? Okay, and the reason I said no is because I didn't want you to debit back to the prepaid. That's going to put it back to where it was, right? You have to debit what? Insurance expense, because 9,500 has expired, hasn't it? Expense expired, which was the answer to this question? Okay, good. You'll never forget that one. Okay, good. Good job. Okay. Okay. Here's what's going to happen. Come on up, sir. After you get through these first 4 chapters, guys, really these first 3 chapters, chapter 4 that we're going to talk about here in a little while is really more of a variation on the same theme that we've been talking about. So these first 3 chapters, once you get this part down, everything else is just, I don't know, a folly. Are you going to be in that movie, The Accountant? Maybe. Okay. All right. So let's go ahead and let's take a look at this one. And using the... What's the matter? You don't like what she wrote up there? Okay. It's got plenty of space now. Okay. So using the same facts from question 6. Oh, you're doing number 9. Okay. Okay. I don't know why I said question 6 anyway. It still doesn't make sense. But anyway, you're doing number 9 now? Okay. And so what are we asking for? The insurance expense? Okay. So you're going to go ahead and set up the insurance what? Expense account? Okay. Okay, good. Because they gave me here what? That there was a beginning balance. Nice. Look at that. He's going to town. So he's setting up both the what? Both the insurance expense and the prepaid insurance? Nice. You are going to be in that movie, The Accountant. The insurance expense account had a beginning balance of $14.50. I'm going to be like, you ever see when, they go to those religious things and the preacher says something and then everybody else repeats it? The insurance had a balance of $14.50. Then tell me what happened.
Prepaid insurance had a balance of $3,800.
The prepaid insurance had a balance of $3,800. Okay.
It was determined that $2,800 of prepaid insurance had expired.
So they're telling us that $2,800 has expired.
Yes, sir.
Okay, so what do you want to do with that since it's expired?
So I'm going to credit it $2,800.
You're going to credit the insurance of $2,800. That's right. Good. Do you have a balance in there now?
Balance now is $1,000.
Nice. What are you going to debit?
And then we debit the insurance expenses $2,800.
Debit the insurance expense $2,800, bringing that balance up to 4,250. Beautiful. I know who I'm sitting next to during the exam. Very good. Okay. Nice job. What was your name again?
Omid.
Huh?
Omid.
Omid? Good job, Omid. Nice.
Well, he answered 10 too, so.
Yeah, using the same facts as question 6. Omid is very efficient. He also answered question 10 for us, but not. No. You're not going to get off the hook that easy. Come on up. We'll have you do 11. So there's now what? There's now 1,000 left in the prepaid insurance, right? Okay. All right, good. So you want to try the next one? Okay, you can handle this. It's more of the same. The hardest part is using the stupid pen, isn't it?
Yep.
Okay. All right, so go ahead. And we have a balance in the prepaid rent account before adjustment of what? 18,000? Hello? Prepaid rent, 18,000? Good. Give me the balance of 18,000. There you go. Nice. Okay, so we've got $18,000 balance, right? Okay, good. All right, nice. Now they look and they see that what? So that was rent paid on December 1st, and we want to know what's happening at December 31st. So go ahead and set up the 18,000. If that's 3 months, how much is that per month? Good. Go ahead and write the math over here. 18,000 divided by 3 months, right? Divided by 3 months. Yes, sir. 3 mo's. Okay. And that gives me what? 6,000 a month? Okay. Beautiful. You're a champ. 6,000 a month. Good. Okay, so at December 31st, how many months have gone by? 1. Okay, give me the journal entry.
So that could go for my prepaid. That could go in the same T account as the prepaid one.
Okay, where do you want to put it?
So credit prepaid rate.
Okay,
It's for 6,000.
okay. Nice. What's the balance now?
Balance is now going to be 12,000.
Now we got 12,000. Good, good. Nice and neat. And what did we debit? Debit the rent expense, which go ahead and just underline that number A there, right? Because you just told me what to do, that letter A. Debit rent expense. Just underscore number A, letter A. There it is. Debit rent expense 6,000. Credit to prepaid. Isn't that what you just told me to do? Go ahead, underscore that whole thing. There you go. Nice. For the rent expense? No, why don't you show me how you'd write the journal entry in general journal form? Okay, general journal form is where we put the debit and the credit, right? Okay, that's general journal form. What you did is you showed me the posting. And when we're analyzing with T accounts, guys, we're kind of going backwards, aren't we? We're sitting there putting stuff straight into the ledgers, really, is what a T account is. we would have first made the general journal entry like you're doing right now. Good. Debit rent expense 6,000 and credit what? Beautiful. That's a beautiful looking journal entry. Look at that. No, we're not crediting prepaid insurance. We're not crediting the expense. We're crediting what? Prepaid rent, the asset, right? Credit the prepaid rent. Good. It's a little confusing. I see why you're wanting to put prepaid rent. No, yeah, just credit prepaid rent. Sometimes they'll call it prepaid rent expense, but I don't like that because wouldn't put that on my balance sheet, prepaid rent expense. I'd call it prepaid rent. It's an asset, right? But sometimes the book I see calls it prepaid rent expense, which I don't like that presentation. It's an asset, yes. So I've got 12,000. I've got what? 6,000 for January and 6,000 for February left, right? All right, good job. Huh? Oh, what's the balance now? It would be 12,000, right? You already figured that out? Yes. Ask you based on the facts of the previous question, what's the balance in the prepaid rent would be 12,000. That's right. Good idea. That's what I think I'll do on the test. Okay. Okay, good. Who wants to do this one? Nice job. What was your name again? Sorry, I keep forgetting. Huh? Devon? Good job, Devon. You guys could open up a CPA firm together. Right? Stranger things have happened. The networking that you do in college often parlays into something like that. Okay? All right, good. Who wants to do this one? Why did this thing come back to me? Get out of here. Who has sent me an email asking me a question about this one? Oh, you sent me an email on this one? So you want to do this one?
I already won it. I still give someone else a chance.
Okay, you're right. I think we're going to do the back row. What's your name, sir? Huh? Chester? Come on up, Chester. Represent the back row. So these are the closing entries, aren't they? Right? So they're asking me what I should do to close the revenue account, and I guess you might have to scroll up a little bit so you can see the revenue. You can do it's easier to do with the mouse, I think. You just go like that with the mouse. Theoretically, it's easier, right? Easy for me to say. There it is. There's my revenue, right? And so how do you want to close the revenue account? You can just go ahead and put it right there. The journal entry to close revenue. I think I already got you on pen. I think you're good on pen. See, it's a little glary. Yeah, it's kind of a pain. So the revenue is 7,000. So you want to close the revenue account? No, why don't you give it to me in general journal form? Well, since they're multiple choice questions, it's not like I'm going to say which of the following would be right if you use a general journal versus a general ledger account, right? So, I mean, it's going to be like this where they're asking you what has to be debit or what has to be credit, or they'll show you different journal entries, and you have to know which one to pick. But there's not going to be, would you use a ledger or a journal for this? Okay, there will be a question that will say the process of going from the journal to the ledger is called what? Posting, right? Okay, that's about the extent of that, what you need to know about that. No cash. We're just closing the revenue account. Is revenue a credit? Okay, during the year it's a credit, right? So we do debited cash, credited revenue, let's say. Okay, so now we want to close that revenue account at the end of the year. Since it's a credit, what do you want to do to close it? Okay, so debit my revenue. You can just put rev. Good. Going to debit it for 7,000, right? Good. Now you got to credit something, right? What do you want to credit? No, I'm going to credit my income summary, right, for 7,000. This is a closing entry. So go ahead and debit income summary. You can write summary underneath the word income, so you have room to write the number. Okay, good. Sum is fine for 7,000. Is that how we close the revenue account? That's okay, 7,000. Right? Is that the answer? Scroll down, see if that's. Oh, okay, you're gonna fix that. Scroll down a little bit, see if that's the answer. There it is, right there. We did what? Credit to the income summary for 7,000. That's what we did because we had to debit the revenue. Right? We're good, Chester? Right? Okay, good. Excellent job. Good job. Now, I'm going to go ahead and do the entire closing entry here, which is going to be to do what? Debit revenue for how much? 7,000. Good. And then I have these expenses up here, don't I? Okay. So I start looking at those expenses. I've got salaries and wages. Is that where it starts? Okay. So I got salaries. I'm going to credit that for what? 3,000? 3,000. Okay. Then I got what? Rent expense. And I'm going to credit that for what? 1,000. I've got what? Ad expense. Thank you for 800. Good. I've got what? Supplies expense for 300. Because I want to close that, don't I? Okay. And then insurance expense. Did we do this one before? I'm having a flashback. Insurance expense of what? 100? Okay. Now the total of all those credits so far is what? 5,200? Just peeking up there. Okay. Is 5,200. So I need another credit, don't I? Of what? 1,800? That credit of 1,800 goes to income summary, doesn't it? Right? So if I'm looking at income summary, of course, it would have started the year with 0 income summary. It would have started the year with 0, and now I just did what? Now I just credited it for 1,800, didn't I? Right? But I want it to be 0 by the end of the year, so I'm going to do what? I'm going to debit income summary. For 1,800, and what am I going to credit? Credit retained earnings, because I have some earnings and I want to retain them, don't I? For 1,800? Is that the whole thing? Even though that question didn't ask for that, it just asked for the revenue part of it. Does that answer your question? Okay. Okay, good. Now when you come down here, then is it true that the entry to close the expense account included a credit to rent expense for $1,000? Okay. Okay, good. After all the revenue expense accounts have been closed, the balance in the income summary had a credit balance of what? 1,800. That's also true? Okay. Come down. After the revenue expenses accounts have been closed, the balance in the income summary, we got that. Number 15 now. The entry to close income summary to retain earnings included a credit to retain earnings of 1,800. You're right, Chester. This is almost impossible to see up here. I have to move this out from under this light. Okay. Okay. Now, if we reported retained earnings of 35,000 on June 1st, that means that the beginning balance in retained earnings was how much? 35,000, wasn't it? And then didn't we just credit it, increase it for what? For 1,800. That's my net income, right? So I add my net income of 1,800. Is that all they told me here? I guess they didn't pay any dividends. Dividend is 0. Okay, minus dividend, but dividend is how much? 0. And so I've got an ending balance of 3,800. 36,800, I mean. Supplies, blah, blah. We've done it 92 times now. 5-month service. The revenue reported from this transaction. Who wants to do this one? Who wants to do this one? You want to do this one? Okay. Come on up. The Warriors open training camp yet?
Yeah, they're practicing today. Get Durant out there shooting around.
Okay. So what do we got? We've got this Soundgarden collected 18,200. Why don't you give me the journal entry when they collect 18,200? Even though this question didn't ask for it. General journal form.
Cash.
General journal form for the whole entry when they receive the cash. Go ahead and erase that. Yeah. Good. Debit cash. 18,200, right? Okay, good. And they're getting that in May, right? And so what do you want to credit here? Unearned revenue. That's in May, right? Okay, good. Is there anything you want to do in May for this situation? They got that money in May. You've recorded that in May. Is there anything else you have to do in May? Okay, look at the question. We have what? We have May for 5 months, right? And it's providing service October through February of 2016. Right? So we're going to provide service, look, October, November, December, January, February, 5 months, but that's not going to start until October, right? So if we collect the cash in May, what do we do in May besides the journal entry you just told me? It's 5 months that'll begin when? In October. What do we do in May for other than what you just told me for the collection of the cash?
We're going to have to put 2 months of revenue onto
What do we do in May? What do we do in May?
Put the money in our bank.
Okay, I'm asking you. This is an accounting class.
No,
Okay,
so
so
we collect 2000. We don't,
right,
We can't do it until we give it.
till we earn it,
Until we
right?
earn it, right?
So the answer is nothing, right?
Oh, nothing.
We do nothing in. We do.
That's why I was lost. I didn't know what.
Okay. I could ask you that. I could say what journal entry should be made in May, and the answer would be 0, wouldn't it? Okay, but that's not what this question said. It said what? What should we do? What? The revenue report from the transaction during 2015, right? So in 2015, we're going to have October, November, and December. We're going to have 3 months, right? Okay, good. So if it's 18,200, now go ahead and do what you're going to do. Show me how you get the amount that we should put.
So we have 18,200.
Right?
So you can either times that by 3/5,
Okay. How about you divide it by 5?
or you can
Just-
divide by 5 and times it by 3. So
Divide it by 5 just so we can all see the number there. 18,200 divided by 5. What's the name of that app you're using?
It's FN calculator.
FN?
Yeah.
FN calculator? It's an app.
It's got every kind of. So you guys, I'll show you guys how it has all kinds of interest ones and stuff. So it's a good one. So we have 18,200 divided by 5 equals. Divided by 5.
Good. Divided by 5 equals
3640
3640 times the 3 months.
equals 10,920.
10,920. Nice. Okay. Good. Now, show me the journal entry for that 10,920.
So we're going to go journal entry on at the end of the year.
December 31st. Assume we didn't do anything. Sometimes companies won't do things monthly, right? They might wait till the end of the year for adjustments like this. Or you're the CPA, and as the CPA, you come in and the company hasn't done anything for the whole year, and so you're going to go ahead and you're going to make this adjusting entry, right?
No,
Okay.
Actually, I'm going to go do our debit first. So we're going to debit unearned revenue,
Good. Debit unearned revenue for the amount we've earned, right?
the 10,920, and then we'll credit revenue
Yep.
because it went up. 10,920.
Good. The revenue reported, right, is 10,920, and you just gave me the journal entry to report that?
Yes.
All right, one more question.
Yes.
What's the balance in the unearned revenue account now?
So we take 1820,
18,200,
subtract the 1090,
10,920.
18,200 minus 10,920,
Right, because we've recognized
72,800
72,800.
is left over.
Or what? You could have taken 3640 times 2
Yeah.
and would have given you the same number,
Yep.
right?
Oh, yeah.
Nice job.
And then you, at the end of the year, so then you'd have to,
How much revenue am I going to report in 2017?
well, if you don't make any more money than that, it'd be 7280.
7280 just based on these facts, right?
That's facts.
Which is going to be my January and my February 2015 revenue, right? Okay, good. Good. That's a nice little problem. Nice job. You don't have to erase it. That's fine. You can leave it like that. Okay. Let's see. Any questions about any of these other ones? Number 15. Okay. Did we do the salaries discussion? We didn't finish chapter 3, did we? We still had a couple things from chapter 3 too. Okay. All right. So we'll do that when we come back from the break because it's getting a little long here. But let's just do this. Let's do this one right here. January 1st, 2012, Doolittle Company purchased a computer system for 5670. The company expects to use the system for 3 years. The asset has no salvage value. So remember, we went through that whole big long thing with depreciation last time, where I wrote it all up on the screen, I think here, or up on the board, I forget which now. So we have what? 5670. There's no salvage value, so the salvage value is 0, right? Okay, so our depreciable base is the 5670, right? Okay, I divide that by how many years? 3 years. 5670 divided by 3 is how much? 1890, you say? Okay, good. And so what happens? I sit here, and for year 1, I'm just going to write it down here. For year 1, I debit depreciation expense. $1,890, and I credit what? Accumulated depreciation 8190, right? Okay, and I'm going to go ahead and I'm going to tee up my accumulated depreciation over here for 1890. So I have a balance of 1890, don't I? Okay. Then what? That was year 1, wasn't it? Or year 2012, whatever. Okay, year 1. I called it year 1 here. Okay, good. Then what am I going to do in year 2? Well, actually, let me prepare the balance sheet for year 1 here. My balance sheet for year 1, if I put it right here, is it Mariana? Marlene? How much is the equipment account?
5670.
Huh?
5670.
5670, which is what I paid for this equipment, right? Good. How much is my accumulated depreciation right now? 1890. So the book value, carrying value, I'm putting that as BV, is what? 5670 minus the 1890, the accumulated depreciation, right? That gives me a book value. How much? 3780. With me so far? Okay. Now I'm going to go ahead and do year 2, which I guess is 2013. What journal entry, if this is 2012, year 1, what journal entry should I make in 2013? I'm going to make the same exact journal entry, right? I make that same journal entry every year for this. And so when I do, I'm going to now post over another 1890. This balance comes up to how much? 3780, right? 3780. So now I go ahead. Now I go ahead and I prepare my balance sheet for year 2 in this little scenario. Balance sheet for year 2. There it goes. Balance sheet. What year is it now? Year 2 or 2014. How much is the equipment? Equipment is what? 5670. How much is the accumulated depreciation now? 3780. 5670 minus 3780. What's the carrying value, the book value of the equipment now? 1890. Is that what they asked me? What would be the value of the equipment at December 31st, the end of year 2, 2013? Right? And I've got how many years left to go on this? 1 year left to go. Don't you love accounting? It's telling me exactly what I have left to go here, isn't it? Okay. Okay, good. All right, so let's do this. Let's take the break. Let's make it 10 minutes, guys, because we've got to get through that Chapter 4. I don't even think we'll get to the Chapter 4 quiz. We'll have to do that next time. I want to get us through Chapter 4 so that we have time left over to on next week to practice for the exam. Okay, so make it 10 minutes. We'll come back at 10 to 8, and right, and then we will go through the rest of Chapter 3 and Chapter 4. Huh? The work for what? For 15? Oh, you want me to just scroll it back up? Huh? Oh, okay, that's all right. Doesn't hurt.
So for this one right here for number 12,
Uh-huh.
the answer was D, to credit to income summary. Because revenue credit will debit it to the 7,000 and then
Okay, and what that last problem that we didn't finish from the quiz was talking about is the accrual of payroll. Okay, accrual of payroll. So what happens? In this example, we pay our wages every Friday, and so we paid these people on Friday, October 26th. You almost feel like you need a calendar to be able to answer this question. In this assumption, we don't work on the weekend. We work Monday through Friday, right? So what happens? We don't work the 27th. We don't work the 28th, and we start work again on the 29th, right? Right? So we work Monday the 29th. We work what? Tuesday the 30th and Wednesday the 31st. This is a scary question, isn't it? Okay, so what happens? We work 3 days more since our last pay day during October, don't we? Right? We got paid on. Let me close that door before we get attacked by bugs. We got paid on the 26th, didn't we? Okay, we're going to get paid again on Friday, the what? The 2nd. That's the next week. And so what happens? We work in October. We work Monday the 29th, Tuesday the 30th, and what? Wednesday the 31st. End of the month comes, we have to accrue the wages for those 3 days, don't we? Okay, for the month of October. So if they're paying them $400 a day, they take the 400 times the 3 days. We debit salary expense for the 3 days for October. We credit salaries payable for $1,200, and we're going to pay that on Friday, aren't we? Right? People work what? People work on Thursday the 1st of November and Friday the 2nd of November, and as they're walking out the door, we pay them again, don't we? And we pay them for how many days?
5 days.
No, 5 days. We're paying them now for Monday through Friday that they worked, right? 5 times 400 means that we are going to credit the cash for $2,000. We're paying them for the 5 days, 400 each day. Then what? We debit the salaries payable now, $1,200, because we're now paying them off for the Monday, Tuesday, Wednesday, aren't we? And we go ahead and we debit salary expense, $800 for November, the first 2 days of November, November 1st and November 2nd, $400 a day, right? Debit the payroll expense. So our payroll expense in November so far anyway is what? Is $400, right? $400 a day. Question? If you're waiting for deeper meaning, it's not coming. Question? You sure?
Just because you need to pay right now,
800 goes to expense because we're gathering our expenses by month, aren't we? Here, right? So what happens for October? If I ask you based on these facts, what's the payroll expense for October? What is it? For October, it's 1,200, right? Because they worked how many days in October? 3 days times $400 a day. That's my payroll expense for October, isn't it? For November, they worked how many days? 2 days, November. 2 days times $400 a day. That's 800, isn't it? Okay, but I'm not paying them until November 2nd, right? So the total cash that's going to go out on November 2nd is the full 2,000, right? That's paying them for what? The 3 days in October. October 29th, 30th, and 31st. That's Monday, Tuesday, Wednesday, and then what? Then in November, the Thursday, the 1st, and the Friday, the 2nd, right? And so for November, my payroll expense is what? Just 800, right? I already took the expense for October, didn't I? The end of October. Right? What's my payroll expense in October? 1,200, 400 for Monday, 400 for Tuesday, 400 for Wednesday. Those 3 days fell in October. What's my payroll expense for November? 800 for Thursday, 800 for Friday, right? Okay. What's my payroll payable, my salaries payable after on Saturday, November 3rd? Say it again, sir. It is 0, isn't it? Because I paid them off now. And this whole wonderful thing will start again on Monday. Okay. Okay, good. So that was that. Now, coming over, we start talking about a classified balance sheet. Okay? And before you freak out and say, ho, classified balance sheet, all we're going to do is we're going to sit here and we're going to group our assets and our liabilities into whether we consider them a current asset, current liability, or a long-term asset, long-term liability. Okay? And the trigger is basically, will we use up that money during the operating cycle? Okay, will we use up that money during the operating cycle? So, operating cycle is the longer of the time that it takes us to turn our inventory into cash, or 1 year, whichever is longer, okay? So, if you're a sushi restaurant, is your operating cycle 1 year, or how long it'll take you to turn your inventory into cash? 1 year. If you're it's going to take you more than a year to turn your inventory into cash, I advise you not eat there. Right? Okay? Because they turn their inventory over almost daily, or at least maybe in a couple days, right? Okay? So what happens? Their operating cycle would be 1 year, because it takes what? It takes them less than 1 year to turn their inventory into cash, right? It's either the operating cycle or 1 year, whichever is everybody. Whichever is longer, right? So since it's going to take them less than 1 year to turn their inventory into cash, their operating cycle will last 1 year, right? Okay. If you are a winery, how long will it take you to turn your inventory into cash? Probably longer than 1 year before you're going to be able to turn grapes into wines, right? So their operating cycle is going to be what? Longer than 1 year. I don't know how long it takes, 2 years, whatever. That's going to be their operating cycle, isn't it? Okay. All right. So the current asset will be used up in the operating cycle or 1 year, whichever is longer. So let's just go with the 1 year. idea. Let's say most businesses, right? They're what? It's going to take them less than a year to turn their inventory into cash. So their operating cycle is going to be 1 year. And a current asset is one that you will use up then in 1 year, right? So will you use up your cash in 1 year? You won't? Look in your wallet. Tell me that money's still going to be there a year from now. No, it's not. Right? Okay. So you will probably use up your cash in what? In 1 year. You say, well, no, it's going to sit in my savings account, 25,000. Yeah. Meanwhile, whatever you got in your savings account. Meanwhile, you're sitting there. What? Yeah, but you made 100,000 during that year, and you still had 25,000 sitting there. So that cash that was sitting in the bank got used up, didn't it? Okay. So cash is considered a current asset, isn't it? Because it's probably going to get used up in 1 year. Okay. How about your inventory? How about your inventory? Will that be used up in 1 year?
Most of the time, yes.
Most likely. You got a warehouse full of desks. You're going to sell those. You don't want them sitting around for 3 years, do you? By the time you get around to selling them, they've invented something better, haven't they? So inventory goes obsolete pretty quick. So inventory is going to be a current asset, isn't it? How about your accounts receivable? Are you going to collect that within a year? Yes, you are. You don't sit around waiting years and years to collect on a receivable. So that is typically a current asset, right? Okay. Okay. Now you come over and we start to look at the list of current assets, and we've got cash, we got accounts receivable, we've got a note receivable. If that note receivable is what? Is a 1 year note, right? You could have a 5 year note, in which case that would then make it what? Non-current, right? Well, you can have a current portion and non-current portion if it's going to pay off in installments or something, yeah, right? If you're going to pay over the 5 years, say it's a 10-year note and you're going to pay $2,000 a year, then what? $2,000 would be the current portion of that note. $8,000 would be non-current because that part's going to go past the 1 year, right? But just assuming it's not, if it's what? Going to be paid in 1 year, it's current. Inventory is 1 year. Supplies we typically treat as a current asset. You don't carry around years and years worth of supplies. You're probably going to eat those up, use those up by the end of the year. Okay. Now sometimes people say, well, what if you have 1 jar of peanut butter left at the end of that year? Well, we don't get into, sort of immaterial differences here. You're not going to be having a material amount of supplies laying around for more than a year, so you go ahead and you treat that. Prepaid insurance is typically treated as a current asset because typically those policies are going to go 1, maybe 2 years at the most, but then they're going to be used up, right? Okay. Okay, good. Longer term items, stock investments. You're going to hold those for probably a long time. Investment in real estate. You're going to probably hold those for a long time. Beyond the scope of this class, there are some stock investments that they call trading securities. Trading securities, we assume that we are trading those on a daily basis, and therefore they would be up in the current asset section. Or if the intent of the company, even if it wasn't a trading security, if the intent of the company is to trade that on a more current basis, then that would be up in the current asset. Beyond the scope of this class, stock investments you can just think is long-term investment in real estate. Our property, plant, and equipment, there's our land. Is land depreciated? Do you depreciate land? No, you don't depreciate land. You can't destroy land. I mean, I guess you would depreciate it if there was an earthquake and it got knocked off the face of the earth. You'd sit there and say, well, now I don't have that land anymore, but that would be a complete write-off of the land. Land's going to be there forever, right, barring some sort of weird disaster or something. So you don't depreciate land. We do depreciate our equipment, though, right?
If you had like a mine, you'd amortize or do something like that, right?
If I had a mine, I would deplete it.
Because you're pulling out resources from it?
Yes, if I have a mine and I'm sitting there and I have coal sitting in there and I paid $4 million for that piece of land. I paid $4 million for that piece of land with the coal in it, and then I had to put some mining shafts in there, etc., because I just can't put a big vacuum cleaner on top of the land. I have to put mining shafts to get the guys down there and get them out when they get stuck and all that kind of stuff. So I sit there, and now the value of that thing is what? I'm getting crazy with the zeros. I've been talking too much about the public debt lately in my classes. So we've got what? $5 million here, don't we? Okay. Now, if I take, and I have an engineering estimate that says that I'm going to be able to take 5 million tons of coal out of that thing, that means that I have what? I have $1 per ton that I'm going to deplete as I start to take that stuff out. And so if I take out, what, 250,000 tons in a year times what? Times the $1, I will debit inventory for 250,000, and I will credit my accumulated, now it's accumulated depletion for $250,000 because I have depleted that land down a little bit, right? And then let's say I sell 100,000 of that, I'll debit cost of goods sold for 100,000 and credit my inventory for 100,000 if we were talking about some sort of depletion for land like coal or something that had it. But that's not something we're going to get into in here, other than the fact that I just went through the whole discussion of it. But we're not going to have to remember that. Okay? So if it was that kind of a situation with land, yes. But typically land is not going to be depreciated, right? Okay? Okay, good. So what? We have equipment less the accumulated depreciation, right? We show it net of the accumulated depreciation. Intangible assets, patents are an intangible asset. They call it intangible because what? You know, the piece of paper that it's written on is worth 2 cents, isn't it? Meanwhile, if that patent allows you to produce the touch phone, that's worth a lot of money, isn't it? Okay. Now, it so happens with patents, you have to purchase them from a third party to be able to carry them on your financial statements. You can't say, well, I spent all this money developing this patent, so I'm going to capitalize it. You have to have purchased it from a third party in order to put that on your financial statements. Why do they do that?
Keep people from putting money on their patents overzealously.
That's exactly the reason. Most research crashes and burns. Most research doesn't turn out. And so for the most part, FASB requires us to expense any research that we have. We have to expense that. But if you come along and you buy my research, you buy the patent off of me, now you're declaring that there's value for that, aren't you? And then you could put that on your financial statements if you purchased it from a third party. Okay? Anyway, main thing here is what? Current and the non-current, right? Current going to be used up in a year. These other items, longer period of time, right? Okay. Same thing with the liabilities. Okay. Liabilities will require us to use a current asset if it's a current liability. So notes payable, going to have to pay our cash, aren't we? What? Accounts payable, have to do cash. Unearned service revenue, we're going to treat that as a current liability, right? Okay, because typically we're going to cover that up within a year. You don't usually get, contract revenue that far in advance. Salaries, typically you're going to have to pay that within a few months, aren't you? Or within a month. Okay, interest payable, with those other ones we're going to pay within 2 days, weren't we? Interest payable is going to be current. Non-current, remember the mortgage? I said they use the word mort, you're going to die before you pay it, right? Okay, notes payable, you're sitting there saying, well, John, why is note payable here and here? Because what? If it's a longer term note, it is non-current, right? Okay. Okay, good. And we've already seen our stockholders' equities, common stock, and retained earnings. Okay? So the main takeaway here is what? You sit here, you have your current assets, are those items that you think you're going to convert into cash within a year. Cash is already cash. Non-current is going to be more than a year, like property, plant, and equipment. Those longer-term investments. Current liabilities are going to require the use of your current assets. And then if it's going to be what? Something that you're going to pay further off in the future, that makes it long-term. Okay. Okay, good. Current assets. The correct order of presentation of classified balance sheet is going to be, and you put them in order of liquidity. So it's going to be cash, then accounts receivable, then inventory, then prepaid insurance, I think. Yeah, okay. Okay, cash is already cash, isn't it? Receivable will be cash pretty soon. Inventory is going to be cash maybe pretty soon. Will prepaid insurance ever be cash? Never. Try it sometime. Try and take your insurance policy, your prepaid insurance policy for your car, and go to Safeway and say, can I please have some milk for this? I've got a little bit left on this. What are they going to tell you? Got any cash on you? No, we're not going to take that, right? So even though it's still considered current, it's the least liquid. Okay, long-term investments are going to be long-term. Property, plant, and equipment. And then we have our what? Our intangible assets. Goodwill is considered intangible. And patents and copyrights are what? Intangible. Current liabilities. There they are. Long-term liabilities, long-term debt, for example. Okay. Which of the following is a long-term liability? Long-term note payable or mortgage payable? Bond payable. Oh, which of the following? What the heck's going on with this question? Which of the following is what? Not. Okay, if you miss the not, always got to watch your knots, don't you? Did you ever hear the one about the rope that went into a bar to order a drink? This rope walks into a bar to order a drink. The bartender says, we don't serve ropes here. So the rope gets all upset, ties itself up in knots, gets all frayed at the end, comes back in to the bar and says, I want a drink. The bartender says, aren't you the rope that was just in here? The rope says, no, I'm afraid not. Okay. If my jokes were funny, I wouldn't be an accountant. Okay. All right. So what happens? You got to recognize your knots in these questions. And so which one is not? Current maturity, right? The current portion, obviously. Okay. Okay, good. And then we have our stockholders' equity. Okay. Now, what we're going to do with this number is sit here with the current and non-current is figure out something called the current ratio. The current ratio gives us the ratio of our current assets to our current liabilities. It is a measure of solvency of the company. If the company had to liquidate quickly, would it have anything left over, right? So we want our current assets to be more than our current liabilities, don't we? So this current ratio should be what? Should be greater than 1, shouldn't it? Okay, and so if you look at this company, they have their current assets here of $1,020,000, and then they have their current liabilities of $344,500. So what do? They pick up the current assets, $1,020,000. They divide that by what? Current liabilities of 3,445, and they have a what? 2.96 to 1 current ratio. Is this good? Yeah. It's pretty good. If this is good, then 12 must be beautiful, right? As a current ratio. At some point, this current ratio, and it depends on the industry, gets too big. Because why are they holding all of this cash when, in fact, they could be using that cash somehow productively invested in assets or something that are going to be productive to the company, right? So we don't want this number to get too big. It depends on the industry. I'd say current ratios in the 3, 4 to 5 range are considered very healthy. You start getting much higher than that, again, depending on the industry, then we'd have some question as to why you have such a high current ratio. Okay? Okay, good. And they give it to us for a couple different years here. And they get compared to industry. See how they compare us to an industry average? And then they got Macy's here, whatever. Okay, benchmarks. Okay, assumption in financial reporting, going concern. What does that mean? That means that we assume that the company is going to continue in business for a period not to exceed 1 year. We do not go out longer than 1 year in this. Why not? Why do we limit it to 1 year when we're considering if a company is going to go out of business? Because we got to keep these cowboys on the range, don't we? We can't be sitting here having somebody going, well, I'm auditing Chevron, and, I've seen those Tesla cars, and Chevron's done. Give them 50 years. They're done, right? Okay, that's too far out into the future, isn't it? Who knows, right? So to keep people from going crazy, when we have a going concern assumption, it is for a period not to exceed 1 year, okay? Not part of the scope of this class. Auditors are required to do specific procedures to see if there is substantial doubt of an entity's ability to continue as a going concern. And if they believe that's the case, then they have to put something in their audit report that warns investors of this potential situation where this company is going to go out of business in 1 year. Okay? But they don't want auditors going nuts having to say, well, maybe it's 5 years. Maybe I better look out 5 years and see what's going on. So they limit it to what? They limit it to 1 year. Okay, management is also supposed to make this analysis to see if there's substantial doubt about their company's ability to continue for a going concern for 1 year. Okay, time periods, what? We can have a quarter, we can have, each year, all the way out to the end of the business. But we have this going concern does not exceed 1 year. Okay. This is up. It's not foreseeable future. We limit it to 1 year. I don't know why they're saying foreseeable future. I should take that out of there. It's limited to 1 year, not the foreseeable future. Give me a break. We'd be here the rest of our lives trying to figure out what is the foreseeable future. Oh, wizard. Okay. What would warrant somebody what? Being audited past 1 year? Audits usually cover the 1 year period, whatever the reporting period is. So from January 1st to December 31st is usually the period for an audit. Okay?
No, just like
What was the question? We were talking about Trump?
What are you worried about?
Oh, if you're talking about, the
like somebody, just like a regular individual, what would warrant, like, let's say they get audited.
you're talking about like a tax audit?
Yeah, like a tax audit.
Basically, if there's some sort of indicator that comes up, then they would go ahead and audit you. And IRS is very secretive about those indicators as to what it is. Like, let's say, for example, your taxable income decreases a significant amount from 1 year to the next. That triggers a flag, and they say, well, what happened? How come all of a sudden that net income went down? And that could cause them to audit you. Now, when they audit you, they're going to audit that return for that given year. The return covers a year. That does not preclude them from saying, well, now that we audited you for 1 year, we're going to go ahead and we're also going to audit you for years 2. We're auditing you for year 3, but while we're at it, let's pull in years 1 and 2 as well. And they can certainly do that. That's within their scope of their authority in the government, right? I actually went on an audit one time with an IRS agent because our office wanted to see what they were doing on the audits, and we wanted to come in after the audit was already done and go back in and see that they did the correct procedures. And so we come in after this lady had already been audited. Now she's being audited again, but now I'm coming in to see that I'm auditing the auditor to see if they did the audit correctly. And so the lady gets all upset, and she's like, this is the second time that this has happened to me, and I know people that don't even pay their taxes. They never get audited. What do you think the IRS agent said? Especially with me there. She says, well, would you like to give us the name of those individuals? So something like that could tip off the audit as well. So there's a lot of things that can happen. When I interviewed for the IRS, I interviewed for them, and they said, what if you were on an audit and you were sitting in your desk at your office, and you heard your neighbor being audited, and you heard your neighbor telling the auditor, your coworker, the other IRS auditor, that they didn't make any money last year. Meanwhile, you knew they had made all kinds of money. What would you do? And I said, I wouldn't say nothing. I mean, in Hayward, you'll get whacked for that, right? If you go and you start ratting somebody out. Did I get the job? Well, I didn't get the offer from IRS. So they are very aggressive in wanting to make sure that the tax is payable, but they can't audit every single person. So they have certain indicators that will cause them to go ahead. And they might do, not maybe this particular thing, but they might do ratio analysis, right, to see what's going on. How come your income has changed significantly from one year to the next? Okay. Now, the reason Trump doesn't want to release his return is who knows why. The excuse that he's giving is that he doesn't want to release it while he's saying he's under audit. And by the way, nobody even knows if he's being audited because IRS won't tell you if somebody's being audited. He's claiming he's being audited, and he doesn't want to release his return. And as a CPA, I kind of understand that. There's a lot of things from Trump I don't understand or I think is complete you know what. But this one I kind of understand a little bit because what happens if he releases his return, now every amateur auditor in the world is going to look at those returns once they're released and say, well, there should have been this and there should have been that, and it's going to just feed the beast all the more for the IRS to say, oh, we hadn't thought of that before, a good point. And so that's probably, well, that's got some credibility from my point of view. Okay, anyway, obviously well beyond the scope of what we needed to worry about here. Okay, all right, so let's get ourselves into chapter 4, okay, and oh, I should have hit pause while I was telling that story, huh? Okay. It's all right. I'll post it on YouTube. Those are all old stories now. Anyway, you know half my stories are made up, right? That's the question, right? Okay. Okay, guys. So I want to get us into chapter 4. Just quickly, these last couple questions that I said I would skip. Okay, look back at those on your own. It's the same exact facts that we had in what? In the discussion of salaries payable. I just put the same facts in the form of a question here that we had on the slides. The only thing is, please make sure that what? That you have updated yours, because I think there was a typo, right, sir? I said what? I said November 9th when I meant November 2nd. So I think I fixed it here, so please fix it on your paper as well. What's the year? I mean, what's the date? November 2nd, right? I fixed it here, but I didn't fix it on your file. It's November 2nd. Okay. On a classified balance sheet, inventory is what? Inventory is what? Current asset, right? Okay. Okay, good. Can I close this now? Okay. All right, good. Let's get ourselves into, I'm just not going to save that. Let's get ourselves into the handout. Everybody should have the handout. Everybody got the handout? Okay. All right. So we are now officially in chapter 4, and we're going to go through this handout. What time do we get out of here? 8:45. Perfect. Okay. So let's just go ahead and let's take a look. And I'm assuming this company is just starting business, so they debit cash and they credit common stock. Sound familiar? Okay. And when they debit cash, we come over, we debit cash, $294,000. We credit the common stock for $294,000. Where's my common stock? Oh, I didn't put it on here? Okay, that's all right. Because I don't prepare the balance sheet, but if you want to have a T account for common stock, you can write that in. We just credited it for what? $294,000, and that gives us the balance of $294,000, and that's all we're going to do with the common stock. So I think that's why I didn't even put it on here. because it's really not significant. 294,000 is the common stock. Balancing common stock now. Okay. Okay, good. Now we come over and we acquire some inventory. Okay, so we go ahead and we purchase the inventory, and we purchase the inventory for 310,000, and the terms on that are 210 net 30. Now, when you see that, and you're going to need to know for your exam that when you put your inventory up at 210 net 30 like that, that's right. I just want to find the slide that describes that. Where'd it go? I guess it's down here. There it is. 14. Thank you. Okay. These are how we talk about terms for a discount. 210 net 30 means, as Sherry was saying, a 2% discount if you pay the bill within 10 days. If you don't pay within 10 days, you have to pay the whole amount in 30 days. I don't know why they say net 30. They should say gross 30, because you have to pay the whole amount if you don't pay within this 10 days, right? Why does a company offer a 2% discount if you pay them sooner?
So they collect their money faster.
They get their cash sooner, so they're willing to give up some cash to get their cash sooner, right? Okay, so they offer this 210 net 30. Now you look at this thing and you say, okay, this is just a funky little accounting thing. Wars are fought over these terms, okay, when companies are negotiating contracts. Well, okay, now we got to get them into 210 net 30. No, we got to get them into, and they go through all kinds of back and forth negotiations over these terms, right? Okay, but 210 net 30 is all you need to know for your exam. We have these other ones up here, but we're going to always use 210, and I shouldn't say always use 210 net 30. We could say 2, and if we say we could say 310 net 30. That means what? 3% discount, right? It could say 110 net 30. That's a 1% discount, okay? Huh? Could be 5 days. That's right. Whatever, right? Okay, so, but that's the way that's read. Okay, good. So we've got this situation now where we purchase some inventory, 210 net 30, and we come over, and is inventory an asset? So to increase it, we debit it for this 310,000, and then we credit the account payable for 310. And if you look on your paper, guys, I went ahead and I teed it up. You can see my writing, my beautiful writing there. Account payable, I went ahead and just stuck it in there for what? A credit of 310,000. See how I wrote that in there? And the balance is 310 now. Okay. Okay, good. Now we come over and we return some of this stuff. I don't know. We ordered green and they sent us blue. I don't know, whatever. We ordered white, they sent us black. We send it back because we don't need those, right? And so what do? Since we're returning those, we go ahead and we credit the inventory now for $10,000. And I kind of wrote it up here. Probably should have written it the next line down, but this won't hurt anything. We're sending it back, 10,000. We credit the inventory for that, and we debit the account payable for 10,000, because if we're sending that stuff back, we don't owe the guy 310,000 anymore, do we? We just owe him 300,000 now, right? You can see where I wrote that in on your paper. Okay, so we send that stuff back. Then what? Then we go ahead and we pay the guy within the discount period. So if we're paying him within the discount period, you would take the 300,000 we owe him. What's our discount? Times 2%, 0.02 is the discount, 0.02. And so we're going to get a $6,000 discount, aren't we? So the guy is willing to accept $294,000 cash to pay off a payable of $300,000. Isn't that great? Okay, so what's happening? We go ahead and we debit the payable for $300,000. Is that zero now? That's zero now, and you're kidding me. You only had to pay $294,000 for that? That's correct. So we go ahead. Where's my cash? Did I tee up cash here? I didn't tee up cash either? Where's the cash? Oh, there it is. I go ahead and I credit the cash for $294, and so what happens? Now my cash is zero because I had issued the common stock. And that was the debit to cash, and now I'm crediting it at zero, isn't it? Okay. Okay, good. Now I come over and I sit there and I credit the inventory for $6,000 because what? I'm not paying the full $300,000 for that inventory. I only paid $294 for it, didn't I? Since I only paid $294 for the inventory, then the inventory should be carried at $294. How much cash did I pay for it? $294,000, didn't I? So I sit there and I credit the inventory. I didn't pay $300,000 for it. I paid what? $294 for it. Isn't accounting beautiful? Okay. So again, I have this 2% discount. That means that the guy is going to be willing to accept $294,000 of cash to pay this thing off. I have a $6,000 discount. That $6,000 discount got to come out of my inventory because I'm not paying full price for that, right? Right? Okay. Okay, good. So I go ahead and I've got that. Now I've got some inventory, and I'm going to go ahead and I'm going to start to sell it. Okay. So when I sell the inventory and I say I sell it for $160,000, even though it only cost me $100,000. Why do I do that? Because the voice told me to go forward and be profitable, didn't it? Didn't it tell me something like that at the beginning, right? And so what happens? Since I have to be profitable, I sell my stuff for more than my cost, right? Okay. So I go ahead and I debit the accounts receivable, $160,000. And since I do have a sale here, I credit my sales. Sales is like revenue, but when we're selling merchandise, we call it sales, right? If we're providing a service, we call it service revenue. If we're selling merchandise, we call it what? Sales, right? But it's like revenue, isn't it? Same effect as revenue. So I credit that, and then I debit my cost of goods sold for $100,000. Isn't that the cost of what I sold? Cost of what I sold is $100,000, and I'm giving up inventory that had value of $100,000, so I'm crediting the inventory, right, for $100,000? Okay? Okay, good. Then what? Then these people have the nerve to return my goods that I sold to them. How dare they? Okay, but what happens? We sent them the wrong thing or whatever, or we have a deal where they can send it back within a certain period of time. Whatever, we have a sales return. So what do? We debit sales return for $30,000. We debit sales return of $30,000, and when we do, we come over, taking a look at our T accounts. Where'd my T accounts go? Sales returns. Did I tee up my sales returns over here? I did not? Okay, well, tee it up. Sales returns somewhere. And that was what, a debit of $30,000? So it has a balance of $30,000. And what? Oh, by the way, notice when I sold my stuff, I debited my cost of goods sold for $100,000. When I sold the stuff, remember I did what? I credited my sales for what? For the $160,000, debited the accounts receivable for $160,000, right? There's that debit for $160,000, credited the sales for $160,000, debited the cost of goods sold for $100,000. And I'm just showing you now that debit to cost of goods sold is sitting there for $100,000, right? That's just the debit to cost of goods sold, right? But then what happens? Then they go ahead and they send me back this 30,000 worth of sales. So I debit my sales return for 30,000. I credit my accounts receivable for 30,000 because if the guy's sending me the stuff back, then there's not an expectation that he's going to pay me the full 160,000, right? So when I find my accounts receivable, I credit that. So now he only owes me 130 because he sent me 30,000 worth back, right? Since I have reversed the sale, I debited the sales, I debited the sales returns, and I credited the accounts receivable. Now I'm going to go ahead and do what? Put the inventory back because he gave me the stuff back, didn't he? So in this problem I said it was a what? 30,000 was the sale return, but there was a cost on that of 18,750 for me. So I debit the inventory, 18,750 to put it back into inventory. I credit the cost of goods sold, right? Because that stuff came back to me. Okay, so I have that amount that has come back. Okay, all right, good. Now I come down and I tell you that there's a little rent expense that I have for the period. I debit rent expense. I credit rent payable, just like we were doing in Chapter 3 where we accrue our rent at the end of the year. This is Chapter 3 now, isn't it? And then I have a little interest expense. Okay, I debit my interest expense. I credit my interest payable, just like Chapter 3, right? Isn't that what we did when we took the 70,000 times the 12% times the 112, whatever, and we set up the interest expense, interest payable. So that's Chapter 3 all over again, right? Okay? Okay, good. So now I'm ready to look at my income statement, and that's really the focus of this discussion here is the income statement. And what happens? I show my sales for the full 160,000, right? Isn't that what my sales were, 160,000? Did I tee up sales here, I hope, somewhere? I didn't tee up sales? Okay. Well, I didn't tee it up, but we know that there was just the one sale for 160,000, right? So I'll put sales here, and I credit it for 160,000. Right, I had that one sale for the 160,000. Now I've teed it up. There it is, right? Then what? Then I had my sales return for 30,000. That was a debit, wasn't it? For 30,000. So that's going to subtract off of my sales. Okay. Then what? Then I had the sales discounts of 2,600. That was because the guy paid me. And when he paid me, what happened? He paid me within the discount period himself, didn't he? So if I sit there and I take what? I take the, how much did he owe me? 130,000? And I take 2% of 130,000. Is that this 2,600? So that's a sales discount that was taken, doesn't it? And so when I go ahead and look at this, I take that, and I didn't tee up sales discounts either. My sales discount is going to be 2,600, right? That's also a debit. 2,600 for my sales discount. Okay. Now you look, and what this company does is they report the sales gross. They then subtract off the what? The sales returns. They subtract off the sales discount to report a net sale, don't they? Now, sometimes students will say to me, well, John, why did they debit the sales return and the sales discount? Why didn't they just debit sales? And then we wouldn't have to deal with these other accounts, sales discount and sales returns, right? And the reason is that the company probably wants to keep track of how many people are taking their discount, and they want to keep track of how many people are returning their goods, right? Why do they care if people return their goods? Maybe there's a manufacturing issue, or maybe we've got really good advertising and lousy product development or something like that. People order stuff, and then when they see it, they're like, this is horrible, right? Why do we care if people take our discounts? if everyone's taking our discount, and it's this huge amount that everybody takes, maybe we're offering too sweet of a discount, right? If nobody takes our discount, maybe we need to sweeten it a little bit, right? So that people will take it. Okay, so we go ahead and we keep track of these accounts here, but at the end of the day, they are reducing my sale. If somebody returns, that's a reduction of my sale. If someone takes a discount, that's a reduction of my gross sales, isn't it? Okay, and so we have your sales minus your sales returns minus your sales discount gives us our net sales. We then take off our cost of goods sold. Notice our cost of goods sold was the 100,000 less the amounts that got returned, right? Remember we said the cost on those was 18,750. So we report our cost of goods sold. Sales minus cost of goods sold is called gross profit. Sales minus cost of goods sold is called what, everybody? Gross profit. Sales minus cost of goods sold is gross profit. Good. Okay. All right. Good. Then we go ahead and we start taking out our operating expenses. Rent expense is considered an operating expense because we can't run our business on a day-to-day basis unless we pay our rent, right? For our building, whatever. Interest expense, we take that out. That's considered non-operating because we are not in the business of loaning money and borrowing money, etc. We are not a bank. If we were a bank, interest expense would be considered an operating expense because it's our day-to-day business, isn't it? Okay, but we would consider that non-operating, our interest expense. Difference between our revenues and our expenses, we've already learned, is what? Net income. Okay, so that bottom part of the financial statement, rent expense, is an operating expense. Interest expense is a non-operating expense, but just like revenues minus expenses are net income, right? Okay. All right, good. So let's look back at this thing now, and let's see what was unique here. Okay. The things that were unique from what we learned from the previous chapter is we now are dealing with what? Inventory. We didn't have that before, right? Okay. The other thing that we're dealing with that is new here is these discounts that termed what? 210 net 30, right? If we're purchasing and we take the discount is going to be what? Discount is going to be subtracted off of the inventory, isn't it? Okay, if we're sitting here and we have a return comes off of the inventory. Okay, if you're sitting here and you're dealing with what? Dealing with our sales now, we call it sales instead of revenue. Okay, we have now what? Cost of goods sold, and we take that out of our inventory, and then if we have what? We have returns. We put those into an account called sales returns. We go ahead and obviously credit the receivable for that. And then what? We also need to bring back the inventory. And then when we go ahead and we collect on our receivable, where's my collection on my receivable? Right here. If we take the discount, we put that into an account called what? Sales discounts taken. And so when we end up here, we end up with what? We end up with our sales. Our sales being what? 160,000. And this is a fine time for the pen to start to crap out on me here. We have our sales minus our what? The sales returns, the stuff that got returned back to us, less the cash discount gives us what? Net sales. We take off the cost of goods sold and we have our gross profit, right? Okay. All right. Now, before we get out of here, we got a couple minutes left. I want to go ahead and I want to go now through the slides, not all of them, but some of the ones that are basically going to be a review of what we just talked about. Except I didn't want it from this slide. Okay. Okay, so we're obviously talking about what?
Quick question.
Uh-huh.
I thought, like chapter 4 in the chapters previous, it was
Yeah, I took it from a different book that this would be chapter 5. Okay, so it's still chapter 4. And what's happening? We're sitting here, we have retail merchandising outfits, for example, what? Walmart, whatever, right? Okay, we have our sales revenue. Our sales revenue less what? Less our cost of goods sold gives us gross profit. That gives us less our operating expenses. They didn't show non-operating expenses here, but they could have. If we had non-operating expenses like interest, we take that off in the calculation of our net income, right? Right? Okay. Come over and what happens? We have our beginning inventory. We have our beginning inventory plus whatever we purchase for the period gives us the goods that are available for sale. And then what? Minus what we have sold is our cost of goods sold, and we are left with ending inventory, aren't we? Okay. And so if you take a look back at the example, that was pretty much what happened in that example. Okay, we'll look back at that next time. I'll tell you what we're going to do here in a minute. Okay. Okay. Just quickly, we'll come back to some of these things. Okay. I don't know that you need to worry so much about the example right now, but what I do want you to look at right here when we have the purchase discounts, and I'll show you what I'm trying to get to here. There was a summary slide right here that we have what? We have our sales revenues. We subtract off what? The sales returns, which were a debit. The sales discount were a debit. That difference is what? Net sales, right? Okay. All right, so here's what we're going to do. We're a little bit more behind than I wanted to be, but here's what we're going to do. Next time, we are going to go back through these slides now. I'm going to go back through this example. I'm going to go back through these slides, and then we're going to work our way into the Chapter 4 quiz, and then we're going to take that comprehensive quiz. So we're going to go quickly through the slides and through the example. Again, that's going to take us maybe half hour or so to go through those. We'll go through the practice midterm for Chapter 4. We'll go through the comprehensive practice midterm, right? We're still on schedule to take the exam on the 11th, even though we didn't get everything done I wanted to tonight, okay? So what you should do is you should take a look at this in-class example. Make sure you're understanding it. If there's things you're not understanding, you need to reach out to me about what it is you're not understanding, either at the start of class or sometime before a class to go through that. And then we're going to go back to that example. We're going to go back through these slides, or we'll actually go through the slides slowly for the first time. And then we'll work the practice midterm for Chapter 4. We'll work the comprehensive practice midterm. We should still be in good shape for our test on the 11th. I don't know. Is it? For Chapter 4 it is, not the comprehensive one. Not the comprehensive one. I'll have it up there by next week, yeah, for us. So the actual midterm has 40 questions. I don't know that I'll put 40 on the comprehensive one just because I don't know that we'll have time to go through all 40 of those anyway. But on your exam, it's actually 40. It's only multiple choice questions. 40 multiple choice questions, A, B, C, D, E choices. Usually I give you D. Huh? Yeah, the green Scantron. Okay, guys? All right, don't worry. We'll get through all this next time. We'll be in good shape for the test, all right? All right. See you later. You too. Bye-bye.